Hi everyone, in this video we'll be going over A-Level Accounting 2023 October-November Paper 2 question number 2. So Paper 2 consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks, and the total time limit given for this paper is 1 hour and 45 minutes. Since question number 2 is of 15 marks, ideally you should be spending about 17.5 minutes in order to complete this question, and in this video as well we'll be attempting to solve this question under 17.5 minutes. So without any further delay, let's get started. Simon formed a parcel delivery business on 1st July 2021. On 1st July 2021, he purchased a delivery vehicle for $29,000 from his business bank account. He then decided to depreciate delivery vehicles on a monthly basis using the straight line method. He estimated that the delivery vehicle would have a useful working life of 4 years and would have a residual value of $5,000. Okay, this is for the delivery vehicle with cost $29,000. Then on 1st November 2022, a new delivery vehicle was purchased at a cost of $44,000. The old delivery vehicle was part exchanged at a value of $16,800. So this is our sales proceeds for the old delivery vehicle. Then the balance was settled by a bank loan repayable over 2 years. He estimated that the new delivery vehicle would have a useful working life of 5 years and would have a residual value of $8,000. Alright, this is for the new delivery vehicle. For the first part, we need to state 2 factors that cause the value of non-current assets to depreciate. So the first one is wear and tear. And the second reason could be technological changes. Alright, let's move towards the next part. We need to prepare the following accounts for the year ended 30 June 2023. We need to use the space provided to show our workings. We need to prepare the delivery vehicles at cost account and delivery vehicles provision for depreciation. Okay, I think the best way to do this would be to create a timeline. The business was formed at the date of 1st July 2021. So this is our opening date, 1st July 2021. Then we have the 1 year cycle. This is the 1st July 2022. This is the 12 months. Then a new vehicle was purchased on 1st November 2022. Okay. So it's somewhere here. 1st November 2022. Then we have the 2nd year cycle. This is the date of 1st July 2023 or our closing date of 30 June 2023. And we're preparing all of those accounts at this date. Okay. For the vehicle purchased on 1st July 2021, our cost was $29,000, useful working life of 4 years, and residual value of $5,000. So this is of $29,000, residual value $5,000, useful working life of 4 years. Let's figure out its depreciation. So for the first year, it was utilized for the entire 12 months, right? So the depreciation amount is just going to be our cost minus residual value divided by the number of useful years. So that's 4. This will give the depreciation charge for the year to be $6,000. So for this entire 12 months, our depreciation charge was $6,000. Alright. Then we part exchanged the vehicle at the date of 1st November 2022, which means that during the 2nd year as well, this vehicle with the cost $29,000 was used within 1st July 2022 and 1st November 2022. So that's going to be July, August, September, and October. So that's 4 months. We need to charge the depreciation for 4 months as well. So that will be 6,000 times 4 by 12. Because remember that 6,000 is the depreciation charge for 12 months, and we have depreciation on a straight line basis. That is why we can multiply it by the number of months that we used the vehicle in the 2nd year divided by 12 months. And this will give the depreciation charge for the 2nd year to be 2,000. So within this period, the depreciation charge was 2,000. And both of this is for the old vehicle. Now, for the new vehicle, we had our cost to be $44,000. This has a useful life of 5 years and the residual value of 8,000. So we have 44,000, useful life of 5 years, residual value of 8,000. And within this year, we utilize this new vehicle with a cost of 44,000 for the remaining 8 months, right? So we need to charge the depreciation for 8 months. That will be the cost minus the residual value divided by the number of useful life. But this will give the depreciation for an entire year. So that will be for 12 months, but we only require the depreciation for 8 months. That is why we can just multiply it by 8 and divide it by 12. Again, this is valid because we are utilizing a straight line basis. And this gives the depreciation charge for the 8 months to be 4,800. This is the depreciation for the new vehicle. And remember, for the new vehicle, we had a part exchange as well. And the part exchange value was 16,800. So out of 44,000, 16,800 was the part exchange value, and the remaining was funded by a bank loan. So the remaining amount is just going to be 44,000 minus 16,800, which results in the value of 27,200. This is being funded by a bank loan. Now we can also figure out whether or not there was a profit or loss on the disposal for the previous vehicle. We first need to figure out the net book value at the date of part exchange. Net book value is just the cost minus accumulated depreciation. The cost is 29,000. The depreciation for the first year was 6,000. Depreciation for the second year was 2,000. This gives our net book value to be 21,000. And the value that we actually received was 16,800, which is lower than the net book value. So there was a loss on disposal. And the value for loss on disposal is going to be the difference between the net book value and our part exchange value or the sales proceeds. This results in the loss of disposal to be 4,200. Okay, now let's prepare our accounts. Firstly, we will be preparing the delivery vehicles at cost account. We only record the cost for the delivery vehicles in this case. Okay, let's start with the opening balance. Since we're talking about asset, our opening balance will be on the debit side. This will be at the opening date, which is 1st July 2022. And we only had the first vehicle, which had the cost of 29,000. So that will be our opening balance. Then we made purchase of new vehicle at the date of 1st November 2022. Now we need to include it under the heading of disposal, since 16,800 was funded through the part exchange, and bank loan, since 27,200 was funded by a bank loan. So under the heading of disposal, you can write down 16,800. Then under the heading of bank loan, we can write down 27,200. Then we also need to mention that the previously owned vehicle with the cost 29,000 was disposed during the year, and it was disposed at the date of 1st November 2022. Again, this will be under the heading of disposal, and this will record the cost of the disposed vehicle. That is all. We can now figure out the closing balance. That will be at the date of 30 June 2023. We first need to figure out the total from the debit side. So that's 29,000 plus 16,800 plus 27,200, which results in 73,000. And that will be the total for the credit side as well. Then our closing balance will just be 73,000 minus 29,000, which results in 44,000. Then we also need to show the balance CD as the opening balance for the next period. So that will be at the date of 1st July 2023. This will be the opening balance with the same value of 44,000. This completes the first part. Now we move towards the delivery vehicles provision for depreciation. Whenever there's a word provision, you can just take this account as a liability account. And if we're preparing liability, the opening balance will always be on the credit side. So that will be our balance brought down at the date of 1st July 2022. We have to record the accumulated depreciation at the opening date, which is right here. And at this date, we only had a depreciation of 6,000. So that's our opening balance. Then we also need to add the depreciation charge for the year to this value. And that will be at the date of 30 June 2023 when we prepare our statement of profit or loss. we need to record the depreciation charge for the year. And in this case, it was 2,000 plus 4,800. So that's going to be 6,800. Then we need to subtract the provision for depreciation of the disposed asset on the opposite side. The disposal was at the date of 1st November 2022. We can record it under the heading of disposal. And for this one, we need to subtract every depreciation charge for the vehicle with the cost 29,000. In this case, that's 6,000 plus 2,000, which will be 8,000. That's all. Now we can figure out the closing balance at the date of 30 June 2023. We first need to figure out the total from the credit side. That's 6,000 plus 6,800, which is 12,800. That's the total for the debit side as well. Then our closing balance is just going to be 12,800 minus 8,000, which is also 4,800. We need to show this balance as the opening balance for the next period on the opposite side. So that will be at the date of 1st July 2023 with the heading balance brought down and the same value of 4,800. Alright, this completes our delivery vehicles at cost and delivery vehicles provision for depreciation account. Then we need to calculate the profit or loss on disposal of the delivery vehicle. So we've already calculated it right here. We know that there was a loss on disposal since the net book value of the disposed asset was greater than our sales proceeds. And the difference will just be our loss on disposal. That's the amount of 4,200. Now we need to explain why it may be more appropriate to depreciate motor vehicles using the reducing balance method rather than the straight line method. So remember that straight line method will charge the same amount of depreciation for each year, but our reducing balance method will charge lower amount of depreciations in the beginning years and it will charge a higher amount of depreciation in the later years. And since in this case we're talking about vehicle, the reducing balance method will be more appropriate because motor vehicles will lose disproportionate amount of their value in the early years, which means that they will lose lower value in the early years and they will lose higher value in the later years. And this is also supported by the fact that new motor vehicles will require less repair and maintenance, but as the year goes on, at later date, you will have to provide more for maintaining the old vehicle. So this complies with the matching concept as well. Let's write it down. The reducing balance method is more appropriate because motor vehicles lose a disproportionate amount of the value in the early years but require less repair and maintenance which complies with the matching concept. Alright, this concludes the second question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.